Welcome to Value Vest Daily. Okay, let's just jump right into it. I want to ask you a question. What on earth could possibly cause a trusted asset like silver to absolutely crater by 30% in a single day? I mean, think about that. What kind of news could hit the market that's so powerful it triggers a total freefall? Yeah, you're seeing that right, a 30% drop. On January 30th, 2026, the precious metals market got hit with a shockwave that was, frankly, historic. We are talking about the kind of gut punch move that completely wipes out leveraged traders and forces everyone to rethink their entire investment strategy, basically overnight. And the scale of this thing was just immense. I mean, look at gold. It was riding high at around $5,600 an ounce, and then bam, down 12%. But silver? Wow. Silver was the main event. It just fell off a cliff from $120 an ounce all the way down to $78. That is a staggering 30% collapse. It was the worst single day for silver since 1980. So what in the world happened? Well, it all came down to a single announcement. So in this explainer, we are going to break it all down. We're going to look at what we're calling the Great Metals Crash. We'll introduce you to Trump's Fed pick, the man at the center of it all. We'll look at why growth stocks got hammered and what this all means for a potential great value rotation. Then we'll see if we can find some deep value opportunities and wrap it all up with an investor playbook for 2026. So let's start by unpacking this historic sell-off. The numbers we just saw, they weren't just a blip on the radar. They were the sound of one of the market's most crowded trades just completely imploding. And understanding why that happened is the key to figuring out where the opportunities might be now. So who was the one person who could move global markets this much? Well, his name is Kevin Warsh. On January 30th, 2026, President Donald Trump officially nominated him to take over from Jerome Powell as the next chairman of the Federal Reserve. So who is this guy, Kevin Warsh? Well, he's not exactly a new face around Washington. He was actually a Federal Reserve governor from 2006 to 2011, so he was right in the thick of it during the global financial crisis. But here's the key thing you need to know about him. He has a reputation for being a hawk on inflation. That means he's the kind of guy who is much more likely to raise interest rates to keep prices in check. Now, funnily enough, a lot of people on Wall Street actually see him as a safe choice because he's seen as someone who'd protect the Fed's independence from politics. And if you're wondering just how seriously the market took this nomination, well, take a look at this. These are the betting odds for markets like Polymarket. The chances of Warsh becoming the next Fed chair just skyrocketed to nearly 100%, almost instantly. The market wasn't just guessing, it was pricing this in as a done deal. Now, the shockwaves went way beyond just gold and silver. All those high-flying growth stocks also started feeling the pain. See, a new Fed chair, especially one with a hawkish reputation, completely changes the rules of the game for some parts of the market. Let's break down why that is. Okay, to really get what happened here, you have to understand something called the debasement trade. It's pretty simple. For months, investors were betting that the Fed would have no choice but to start cutting interest rates like crazy. That would weaken or debase the US dollar. So to protect themselves, what did they do? They piled into hard assets like gold and silver. The nomination of a hawk like Kevin Warsh was like dumping a bucket of ice water on that entire idea. The whole story flipped, practically in an instant, from a weak dollar to a strong one. And the market's reaction was, well, immediate. The US dollar index shot up by almost a full percent. That was its best day in months. And remember, a stronger dollar makes things priced in dollars, like gold and silver, way more expensive for anyone buying with other currencies. That can absolutely crush demand and, of course, the price. This whole situation also creates this huge split between different kinds of stocks. On one side, you've got your growth stocks. Think tech and AI. Their crazy high valuations depend on a steady flow of cheap money to fuel future growth. So higher interest rates are basically poison to them. But on the other side, you've got value stocks. Companies in sectors like financials and industrials, they can actually do really well in a strong economy, which is what higher rates are supposed to support. The Warsh nomination was a giant flashing sign that money could be about to flow from growth over to value. And that brings us to the real heart of our analysis today, the great value rotation. Because while a lot of people were hitting the panic button over metals and tech, a whole other group of investors started seeing a massive opportunity taking shape. This is where the smart money starts looking around. So, where exactly are these opportunities? Well, if you look at the data, a couple of sectors really stand out. First, you've got financials. It's simple. When interest rates go up, banks make more money on the loans they give out. That's their net interest margin, and it goes right to the bottom line. Then you've got industrials. Think about companies like Caterpillar. They do great when the economy is humming along, which is exactly the kind of environment a hawkish Fed is trying to create. These sectors, which have much more reasonable price tags, can become a magnet for all that cash trying to find a new home. But, of course, it's not a sure thing. There are definitely risks here. A hawkish Fed doesn't just mean higher rates. It could also mean something called quantitative tightening, or QT. That's basically when the Fed starts pulling money out of the system. If they get too aggressive with that, market volatility could go through the roof. And that could be the pin that finally pops the big AI hype bubble. All right, now for what might just be the most fascinating part of this whole story. After a 30% crash, is there any value left in the rubble? Let's go digging for some deep value and ask the question, could the most beaten down sector of all actually be the ultimate contrarian play? You know, despite all the short-term panic, it is so important to remember that the long-term story for gold hasn't just vanished. Central banks around the world are still buying it up, and plenty of long-term forecasts are still incredibly bullish. The Warsh nomination was a shock to sentiment, for sure, but it didn't fundamentally change the global supply and demand for gold. So this brings us to the miners themselves, and this is where you might find a real disconnect. The market sold these stocks off like gold was never going to recover, but if you look at big established companies like Barrick Gold or Agnico Eagle, their businesses are built to make a lot of money even with gold prices far below the recent highs. So when their stocks get hammered this badly, you're suddenly looking at profitable, world-class companies trading at pretty cheap PE ratios. They got thrown out with the bathwater, which could make them a fantastic deep value play if you think the market overreacted. Now, if trying to pick individual mining stocks feels a little too risky for you, there are other ways to get in on a potential rebound. You can look at ETFs, like GDX for the major miners or GDXJ for the smaller ones. These basically give you a leveraged bet on a gold price recovery. That means if gold goes up, they tend to go up even more. Yeah, they took a big hit, but that could also mean a really compelling entry point. Okay, we have covered a ton of ground: the crash, the cause, and the potential opportunities hiding in the chaos. So let's pull all of this together into a clear playbook for how to navigate what's coming next. First, a little bit of historical perspective is always useful. Big leadership changes at the Fed often bring turmoil. Back in 1979, you had the Volcker shock, where aggressive rate hikes caused a recession but finally tamed inflation. Then in 1987, Alan Greenspan took over right before the Black Monday crash, which was then followed by a huge bull market. So the question now is, will 2026 go down in the books as the Warsh rotation, that historic pivot from growth back to value? So here it is, the value investor's playbook. Number 1, that easy money debasement trade looks like it's over, at least for now. Number 2, a stronger dollar is going to keep putting pressure on growth stocks. This is what opens the door for a real rotation into value sectors like financials and industrials. For those of you with a higher risk tolerance, the beaten-down miners offer a really compelling, contrarian, deep value opportunity. But above all, expect things to stay choppy. Volatility is here to stay, so manage your risk. And keep a close eye on those Senate confirmation hearings in February. That's going to be the next big thing to watch. And of course, just our quick disclaimer. Please remember this is not financial or tax advice. Everything we've discussed here is purely for educational purposes. You should always do your own homework and talk to a professional before making any investment decisions. We really hope this deep dive helped you make sense of what was a pretty chaotic day in the markets. If you found this explainer valuable, please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. And one more thing, we want to hear from you. Drop a comment below and let us know if there are any specific high-risk, high-reward opportunities that you're watching. We'd love to check them out. Thanks for watching.